I'm Anna Pavlova, an academic director of the AQR Asset Management Institute at London Business School, and also a professor of finance here. And it is a pleasure to introduce our second session today, which will be about a paper that made a lot of noise in the industry. As you know, many investors and fund managers rely on ESG ratings to assess companies' ESG credentials. And how good are these ratings? Well, this is what the next paper is going to shed light on. They will show that these ESG ratings from different providers can vary greatly. And let me introduce the speakers who will present this intriguing paper called Aggregate Confusion, the Divergence of ESG Ratings. All authors of the paper are here with us. They are Florian Berg, Julian Kölbel, and Roberto Rigobon. Florian is a researcher at the MIT Sloan School of Management. Julian Kölbel is a head of research and BMW Foundation Fellow at the Center of Sustainable Finance and Private Wealth at the University of Zurich. And finally, Roberto Rigobon is a Society of Sloan Fellows, Professor of Management, and Professor of Applied Economics at the MIT Sloan School of Management. And Florian and Julian are going to present the paper, and Roberto will join them for the Q&A. So over to you now, and we look forward to your presentation.
Well, thank you so much, Anna, for having us, and it's a great honor to be speaking at this event. I'm Julian. I'm going to make the start with the presentation. The title, Aggregate Confusion, the Divergence of ESG Ratings, is a project that Florian and Roberto and I started actually quite a while ago back at MIT. And yeah, I'm going to dive right in. Why do we look at that? Florian, if you could proceed to the next slide. Thank you. We noticed at that time that ESG rating agencies were becoming rather influential institutions. They had been around since, some of them since the 80s, but it has always been sort of a fringe phenomenon in financial markets. And starting around, I would say 2010, this changed. So they were becoming more influential because so investors with a combined $80 trillion in assets under management have signed the Principles for Responsible Investing. And by doing that, they commit to integrating ESG information in some form into their investment. And that is, you know, very often relies on ESG ratings, some form of external data about the sustainability performance of companies. It is really, I think in many ways, the backbone of ESG investing as it is practiced today. We also saw then that big players are starting to buy ESG rating agencies. So the established credit raters, so sort of S&P and Moody's, they were buying ESG ratings, which were prior to that very small companies. There was another sign that you know, the influence of these ratings was rising. And then very recently, sort of some form of regulatory endorsement of ESG ratings is becoming a possibility. In a sort of similar fashion as credit ratings are endorsed by regulators. And that is one further reason why just the relevance of these institutions is rising. And that's why we thought it's important to look at what do they measure, how do they measure, and do they agree in this assessment, which is so central. And well, you see here in the headline, the point is given away, but they disagree or diverge substantially sometimes, not always. So here on the left-hand side, you see a number of companies where if you say this, the spread is very small among these 6 raters that we've looked at. You can see them on the right-hand side. Everyone has a different color. It's Sustainalytics, Robeco, SAM, Visio, Iris, KLD, Asset4, and MSCI. So on the left-hand side, you see a number of companies where they all pretty much agree. So Amcor Limited is, everyone agrees that this is a sort of fairly well-performing company in terms of ESG. On the right-hand side, The first company is Intel Corporation. And you see here that the green dot, that's KLD, thinks that has an absolutely fantastic ESG performance, whereas the majority of the other raters think it's more around average. The 0 on the x-axis is average in our sample, right? And these are not sort of little known companies. If you go down the list, there's Barrick Gold and AT&T and Porsche. So these are major companies, and these different rating agencies develop a very different view on whether they are good. Now, this raises a number of questions. For investors, it's the question, which companies are now the good companies in terms of ESG? For the companies, there's a question of what is expected of us. If rating agencies are supposed to convey some sort of market expectation with regards to ESG, then this expectation is expressed in a sort of divergent way. And for academics, it also obviously creates a problem, because how do we now work with ESG ratings empirically? And this relates to, for example, something like the meta study that Alex mentioned in his talk just before. This question sort of, does it lead to performance if you invest into ESG companies? There cannot be a conclusive answer if there are different ratings to start with, because depending on which one you use, the answer will differ, obviously. So these are the problems. We go on to sort of find out what drives the divergence, and we find that both aggregation and measurement are very relevant. And by aggregation, we mean that raters select and weight categories differently. So some might focus more on water, others might focus more on human rights, others might exclude, for instance, things related to the supply chain or to products that companies produce. But the second important driver is measurement. And by that, we mean that raters use then different indicators to assess the same category, for example, water or human rights, right? And these two things are, aggregation is in some sense a matter of taste, what you think is important for your investment thesis, for example, or based on your values. But measurement is more a problem of, how do we manage data? How do we generate data? How do we find out about these things? So it's two very different problems, right? In order to do this analysis, Florian, if you will move to the next slide, please. We look at these 6 rating agencies. So you have here the original names. Some of them have changed. For example, Robeco Sam, actually sort of coming from Zurich, Switzerland, is now, since I think this year, has been bought by Standard & Poor's Global. And that's what I've mentioned, that there's some consolidation going on. But here you have the original names and the current owner. You see they have very different numbers of indicators that they use to support their final assessment. And that's a relevant problem for us, because Florian will explain that we had to sort of make a match between all these indicators. The baseline year for all the results is 2014. It's a kind of while back. But I can tell you that we did a robustness check in 2017, and the results have been very stable. So we don't think this is a big problem, hopefully. And there's nearly 1,000 firms, so 924 in the common sample. Okay, now just I'll give you sort of the rough idea of how we go about this. We describe ESG ratings in 3 elements, where we think you sort of capture the most important elements in a sort of very simple way. Scope, we call which attributes are included in this rating. ESG is a wide field. Obviously, it includes E, S, and G, environment, social, and governance. But below these 3 pillars, there are still a large number of issues that you could look at. So one essential question that you need to be asking when you look at an ESG rating is which attributes are included, the full list, right? And you can make choices there. The second one is measurement. How are then these attributes measured? If you look at labor relationships, for instance, you can look at the degree of unionization, you can look at incidence of court cases, labor-related court cases. You could look at wages. Like there's many different ways you can try to assess that category. So you have to make choices there. And thirdly, there are the weights, right? You have then a number of categories, and ESG ratings give one number. There's surely problems with that, but that's the product that's created, and you have to aggregate all these indicators into one number. And there again, you have to make choices how you do that, basically to assign weights to these different aspects. Okay, with that, I'll hand over to Florian to sort of take you through the results of our study. Florian.
Thank you, Julian. So let me take you actually into a deep dive into the divergence. But first, as Julian showed, we have actually, when we downloaded the data, we got a lot of different indicators in different granularity. So some actually raters like MSCI gave us 38 indicators. Others like Asset4 gave us 282 indicators. So we needed actually to create a common language between those raters and those indicators in order to actually compare them. And we actually created our own taxonomy, but we also used SASB, and SASB are the broadest categories. Alex introduced it, and I'm very happy about it. So I don't have to introduce it again. I just say that those 26 categories, actually, we matched them to our indicators. Interestingly, we only found indicators for 24 of those categories. So you see there's also already, even between SASB and this really massive disclosure standard and the ESG raters, there's already a scope divergence. So having now classified and matched all those indicators, we can actually compare them now. And we just do that very simply by calculating correlation coefficients. I'll show you them here with a heat map. Just bear in mind, minus a correlation coefficient of -1 means they are perfectly negative correlated. 0 means absence of correlation, and 1 means they are perfectly correlated. And you see those dark green fields with 75, 80%. So yeah, it's very much, there is some data fields that are very much correlated, but you also see -50%, the red one, quite at the bottom, selling practices and product labeling. Selling practices and product labeling here, it just means, for example, advertising marketing. As an alcohol company or tobacco company, do you target very young adults or not? And you see that between KLD and Sustainalytics, the correlation is -50%. That means if KLD thinks this is a great company, Sustainalytics most likely thinks this is actually a very bad company. And yeah, what do you do of that? So as you see, the correlations they're all over the place. And we can actually say this is actually a measurement divergence, because fundamentally we try to measure the same thing, but we come to a different conclusion. We also see there's those blank fields, and that mean actually that there is scope divergence, because some raters do not have actually indicators for all the categories. So now we actually saw those both sources of divergence. What's left is the weights divergence. And so we will actually, I will show you that on the next slide. But first, the next slide will also show us if our common language, this taxonomy that we created, or this matching that we created, is actually a valid construct. Because as you can see, for example, here on the left, there's a category that's called greenhouse gas emissions. And some of the raters not only have greenhouse gas emissions as an indicator, but they also actually have greenhouse gas CO2 emissions, and then other greenhouse gas emissions. So in order to create a category score, we just average them. That sounds very coarse, but we will actually show you on the next slide, this is a valid construct. And the way we go about it is that we try to recreate, so we try to reverse engineer a ratings agency own ESG rating using their indicator data, but through the lens of our categorization. And basically, it just comes down to regression. On the left-hand side, we use the ESG ratings agencies, the ESG rating of the rating agency. And on the right-hand side, we actually use all the their data, but with our categories. And if we are able to explain a fair share, a very good share of that ESG rating, we know that this is actually a good construct. So our measure of success is the R squared, so the variance explained. And that's just at the bottom. You see that the R squared is 87% for Sustainalytics, 98% for Roberto Sam, 92% for Asset 4, 96% for VGI Risk, 98% for KLD, but 76% for MSCI. So what I haven't told you is actually that most of those, or actually all those ESG raters, as Alex showed you with the SASB, say that those ratings heavily depend on the industries. So for some industries, greenhouse gas emissions are very important, for oil and gas, for example, but for the banking sector, they're less important. What we show here, actually, because we don't include industry effects, that we can reconstruct that data, the own ESG ratings, without actually using anything that gives the information that a certain company belongs to a sector. Except for MSCI, if we actually just look at one sector and try to reconstruct the rating, we actually almost have a perfect R squared of 98. So you can see that MSCI depends a little bit more on the industries. And when you look at the methodology, that is actually the intuition you get. So now we can say that this is actually our taxonomy, our matching is actually good, the categorization. Let's look at the weights divergence. If you look at the first category, for example, access and affordability, we have a weight of 0.032 for Sustainalytics. For Roberto Sam, we have 0. For Asset 4, we have 0. For MSCI, we have 0.207. For KLD, 0.099. And this is fairly the same. These differences are fairly the same for all the other categories. So we see actually that there is also a weight divergence. So that concludes we have all those three sources of divergence. What we do now actually is we develop two methodologies in our paper to figure out what those sources of divergence contribute to the overall divergence. And the results are here. This is actually measurement is the biggest source of divergence. How do I measure actually gender bias? Do I look at the progression of women compared to men in a company? Do I look at the women on the board? Do I look at women in management? Do I look at differences in salaries? Those are the questions that fundamentally want to measure one thing, and that is how are women actually treated in the workforce or in the company. But we don't really observe them directly, because if we did, we needed actually someone just behind every person in the company and taking note of every action or non-action to figure out how big the gender bias is. But we don't want to do that because for privacy reasons, of course. So we can only have an imperfect measure here. So that now the choice is what is actually the best imperfect measure. And you see that different rating agencies have different conclusions. The second biggest source of divergence is scope. And the third is weights. This is the overall average between all those 6 raters. And it will become a little bit even clearer when I show you an example of one company, because you can use our methodology in order to disentangle the differences between different raters. And here we look at Asset 4 and KLD. So they both rate Berg Gold. And as you saw, as Julian showed you in this confetti plot, so this wildly colorful plot before, we saw that Berg Gold, there's a lot of divergence between the raters. So this example is perfect to just show how we can actually just show what the difference is between those raters. So, and everything is expressed in standard deviations. If you don't know what a standard deviation is, just take it as a unit. So 0.5 actually, so asset 4 gives a rating of 0.5 for Berg gold. That is fairly okay. It's not super good, but it's also not, it's better than the average of 0. KLD, though, gives a rating of -1.1, which is fairly bad, actually. So you see already they come to a different assessment. The question is now, why do they come to a different assessment? And the green bars actually show the difference in scope. The blue bars show measurement, and the pink bars show the difference in weight. And the biggest source of divergence is the big blue bar, remuneration. So both asset 4 and KLD rate remuneration, but come to completely different conclusions. When you look at scope, for example, asset 4 rates taxes. So for example, tax avoidance is in there, but KLD doesn't. So that is also a contribution of divergence. And when you look at the weight, so the pink, the weight divergence, for example, you look at toxic spills, and toxic spills apparently have a relative weight that is different for asset 4 than for KLD. And so you can actually use that methodology in order to explain those divergences. And so this, all that actually has implications, obviously. And they were already a little bit hinted by Julian. One of the main implication is actually that for academics and also for investors that use academic research in order to justify what ESG does or not, is that a lot of research before has actually been, until recently, until a couple of years ago, has been done using KLD data. But we show that actually KLD data is fairly different from other raters. So the question arises if actually you can reproduce the same study with a different data set. So for us, it's very important, and we point out in our paper that you should always look if papers actually use different ratings, and if they only use one rating, that they really justify why they use it. Same implication for investors. Clarify your ESG preferences. So why do you choose a certain scope, and why do you choose a certain relative importance or weights? That seems very obvious. But when I look at a lot of ESG investors, I don't actually see that. They say we use ESG ratings, but I don't see why they use ESG ratings. So most of the big raters nowadays create their own ratings, like BlackRock, Amundi, Vanguard. They have big teams, but smaller asset managers, they actually don't have the money to create their own ESG rating, to buy the raw data and then aggregate those ratings. So they should actually really have a very, make a due diligence in order to figure out why they like this methodology over another. Same with measurement methodology. You should really dig in deep into the measurement methodology, and maybe you agree with one and you disagree with another, and that should really guide when you use ESG ratings. But it also, our findings have implication for regulators, and I've been talking fairly a lot to regulators like l'AMF, l'Autorité des marchés financiers in France, and that recently put out a letter how to regulate actually sustainability rating agencies, and the ESMA in Europe, and also a letter about how to do that. So there is a big movement, and I think our paper has some important findings for that, or implications for that. And first is that divergence will persist, because as we show that so much of this divergence is actually due to scope and weights, and that's just social preferences. Everyone is entitled to your own preference, right? Everyone is entitled to your own opinion. So there's a reason why those ESG ratings diverge, and they will always diverge. It's not even said that measurement measurement will be consistent forever. Even if we improve measurement, it doesn't necessarily mean that it gets better. And the reason is fairly simple. I always hear this comparisons, even when I talk to those regulators, between credit ratings and ESG ratings, but they're fundamentally different. Credit ratings measure a default or a loss associated to a default, whereas and that is an observable event. So in that sense, we can, whenever my methodology fails to predict something with a credit rating, I can actually adjust it and make it better, improve it. With ESG ratings, that's fairly impossible, because how do you actually really measure gender bias? How do you observe actually the realization of gender bias? Certainly you can look at harassment cases that happened once you created your assessment, but even harassment cases are just really a tail event. So they're really, what you really want to know, it doesn't really tell you how actually things are in a company. So it's really hard to actually observe realizations of ESG ratings. And that makes it that those ESG ratings will always diverge, and we have to embrace it, actually, this divergence. So we shouldn't, for sure, not create a methodology, a common methodology for all ESG raters, because no one knows the truth. No one actually, about when we now, first of all, we have social preferences, but now when I talk about measurement divergence, no one really knows the truth. So what we need is, we need to set the incentives right to reduce measurement divergence. And I think that is another very important point, because even me as a researcher asking for methodologies, how you actually measure CO2 emissions or gender bias, it was really hard actually to get that from rating agencies and to figure out how they exactly do that. So since I don't know how they do it, I can't really criticize them. Also, other academics can't criticize them, NGOs can't criticize them, and even firms that are rated can't criticize them. They only often observe that there are differences between, for example, I showed you for Berg, for difference between asset 4 and KLD. But what you really actually would like to have is that those firms are able to talk to those raters and say, yeah, look, you're completely different when it comes to remuneration. You have a different assessment to KLD. So please, can you explain why? And I think and then they can point out how to improve actually methodologies. And this, I think, would reduce measurement noise over time. So basically what I suggest is that we force ESG raters to be more transparent, and much more transparent about how they measure indicators and issues. And that was it. Thank you. And now please, let's go ahead with the question and answers.
All right. Well, thank you so much, Florian and Julian, for this very enlightening presentation. We have a lot of questions, and many people are asking for your slides and for the paper. And I think I can immediately suggest where they can find the paper. If you just put in your search engine, Aggregate Confusion, I think that's probably enough, and Divergence of ESG Ratings, that will bring you to SSRN. It's a global depository for academic research. And last time I checked, the paper was downloaded 13,000 times. So that's a measure of success of academic papers. So this is where you can get the paper from, and I'm sure the authors can comment on the slides as well. But let me go to questions. So let me start with Rick Laquelle. The issue is very well explained, but the question from an asset management perspective is whether the differences are systematic in nature or whether they begin to diversify away at the portfolio level. The divergence is of most concern to issuers themselves, or those that can try to draw parallels with credit ratings, as you also explained. Perhaps we should expect a degree of divergence, just as we see in analysts' estimates of earnings or assessments of quality. Do you have data on portfolio impact of these ratings?
So first, Anna, thank you so much for inviting us here. This is a great question, and indeed, so thanks for Julian and Florian to take the big task of presenting. So this question is a very good question, and in fact, we are continually thinking about the questions both on the impact that the ratings have on stock returns and also on portfolios. So we don't have an answer yet, but these are type of the questions that we're interested in, understanding the impact that they will have. There are many questions that I saw in the Q&A that are comparing the generation of ESG data to commentary or analyst views about buying or selling stocks. I think it's different. First, it's important how the data is being sold. The ESG rating agencies are not being sold as an advice. Their goal is they are telling investors that they are computing something that is relevant about the ethical behavior of firms. And therefore, in that sense, it is not an opinion about whether or not the stock is going to go up or down. It's an opinion about the ethical behavior of the companies. And therefore, that's the first aspect about we have to have a different standard when we're referring to the quality of the behavior of management versus is this a good CEO or not, or do I think the stocks are going to go up and down? Then the second aspect about that is what is the interpretation that regulators will have for that data. So even though we are trying to think that this maybe should be just an opinion, is this a good firm or a bad firm, and therefore people have it, what will be important is for the rating agencies, for the regulators and investors, they're all agreeing that whatever we are providing is just a commentary about the stocks and an advice whether or not it should be bought or not. I don't think that this is what the rating agencies are trying to do. I think that they are trying to actually, and by the way they proceed is that they legitimately are trying to understand an assessment about the ethical behavior of the firms. They go through massive efforts to understand their procedures, their practices, they interview the companies, all of them. They use alternative data sources to construct, for example, the consequences of their actions, for example, environmental accidents, etc. So there's a massive amount of effort to truly actually measure what is the impact of the firms on communities, on the environment, on different stakeholders, and then from that make an assessment about their ethical behavior or their ethical approach to their business. So in that sense, I think they are different. So they're different from an advice about buying or selling, and they're closer to what we do with credit rating agencies, where we're trying to make an assessment about the willingness and the ability to pay. So that's why I think we tend to put them more on that one. And that's why I think also the regulators are seeing the same emphasis. So I think, let me speak for myself, but we have talked about this between Florian and Julian all the time. We believe that competition here is extremely important. So, I mean, Florian can speak for himself. He's the one with the strongest opinions in this sense, because we really don't know how to measure ethical behavior, to be honest. And if we feel that this is important to convey that information to investors, we need some competition so we can go through a process of divergence at the beginning, but where we are learning about how we measure treatment of workers, for example. How do we measure child labor in the supply chain? How do we measure human trafficking? These are very important things that we better get them right. Otherwise, we are in some sense supporting or at least condoning some behavior that is significantly unacceptable. So competition here is important, so therefore we need to allow some divergence. I don't think that we're expecting that they will nail it and the correlation should be one on all over the place. But I think it's important that we actually get that right. And so, by the way, there was another question. Let me just answer that. So
let me also ask you something to link this a little bit to Alex's presentation. So Alex spoke a lot about materiality, that not all ratings matters, but only the material ratings matter, material as defined by SASB. And he quoted a study based on, now I understand, your favorite rating agency, PLD, that doesn't seem to be in agreement with all others. So what is your take on materiality?
Me?
Yeah, sure.
I am so I need to apologize to start with. I am a macroeconomist that has spent all his life working with statistical offices. Okay, so I am obsessed with measurement. I truly don't understand what the word materiality means. This is just I find several definitions. So let me tell you what I think matters. So, and again, I'm talking as a person that works for statistical offices. And so I would like to know what is the impact of external shocks into the firms. That's kind of a risk measure. And therefore, I would like to know how the environment will impact the different companies, how increasing water supply in water levels will impact a particular company, what happens to agricultural companies in India when we run out of water, etc. So I would like to know how external shocks that are due to ESG will impact a company, both on regulation and shocks in particular. That's the risk approach, and those measures are very important for investors. Then there's a second aspect, which will be what will be my impact as a firm on the rest of the world, all my constituencies and all the stakeholders that I affect. So that will be the environment, of course. It will be the communities, my workers, competitors, the customers, the safety of my products, etc. So I think that all of those measures are important. One, to understand what is my impact on others. And by the way, the other one is what is the impact of others on me. In my impact of others, it's very important to understand how people use my products. So it's very, very important. So the fact that I produce something super clean and then my users misuse it terribly, I do bear some responsibility for that. So I think that that's the way I will define what matters. And in fact, I would like people to tell me exactly what they are measuring. So, so when I want to make a decision, are you telling me that this is the impact of, for example, regulation on my company? Or are you telling me this is the impact that the company will have on communities? So it will be important for me to understand and separate those two things. So if that's what Alex has as a notion of materiality, then I totally agree.
Okay.
Maybe I can provide my perspective, if I may, Anna. So I think what sort of in the more ESG parlance, what Roberto described is kind of this double materiality, right? You have a materiality to the firm. So which kind of ESG factors are value relevant for the development of the stock price? And then the external materiality to your stakeholders. So sort of which of your actions benefit or harm certain stakeholders. I think materiality is a very important consideration. My impression is that most ESG raters try to include that in their rating. And I think in that sense, then indeed, ESG ratings are a little bit like analyst opinions, because it's one thing to measure, how many cubic meters of water a company has used in a given year, for example. And it's another thing to form an opinion whether that amount is too big and will turn out to be a problem in the future. But I think by combining first the sort of the relatively rational measurement of a quantity with that opinion, that mixes something that's verifiable, relatively objective with a opinion that has a lot of assumptions. And I think one way forward would be to separate that a little bit more. I would welcome it if there was disclosure of certain relevant ESG numbers that are verifiable, reliable, come from the company directly, are available for all companies. And then, but everybody has that to start with. And then rating agencies, other people could form opinions on what that means, either towards the firm or towards others. Bunching it together, I believe, is not very helpful, because then we don't know whether differences come from differences in data and measurement, as we say, or differences in this more qualitative assessment of what the data says.
Thank you very much. And just picking up on what you have just said about the standards that are coming up. For example, Connor Kehoe is saying that the EU is about to require the reporting of certain ESG metrics. Will such a mandatory requirement to report lead to at least more measurement convergence? What's your take on that?
Let me answer that question. I think that's actually not a good move by the EU, because this mandatory disclosure of ESG ratings, I mean, what does it mean? Even me, as someone who actually really studied that subject, I cannot tell, as you saw with that divergence, what actually a certain rating means. And so it might be actually that I compare two portfolios and they have different numbers, but they also use different raters. So I actually don't know what I'm not more informed as an investor. And so I think the most likely outcome is that everyone chooses just the ESG rating that maximizes the portfolio score. And so I think that is not, that is not something we should wish for. And the divergence, as I said, we should embrace it. It's not necessarily a bad thing, because it means there are preferences behind it.
Mm-hmm. Very good. So let me also look at the other set of questions. And so people would like to drill into details. We have plenty of questions here. And so one of the questions is about the conflict of interest. And an anonymous attendee is asking whether you got a sense that some rating services are more management friendly than others.
Toward the firms.
Mm-hmm.
No, I don't think that they were more. No, I don't think so. No, I think that the analysts that are doing this are really trying to measure this correctly. So no, not necessarily friendly.
But there is actually something we can answer through the rater effect, right? Yeah, exactly. And so the rater effect, what we show actually also in our paper, what I didn't talk about, is that we the perception as an analyst, the perception of the company as a whole, I actually makes that analyst influence how he rates each indicator. Basically, it means if I think Berg Gold is a good company, then I will, and I look at the greenhouse gas emissions, and I'm a little bit torn between bad and good, then I'd most likely give them a better rating that they a little bit deserve. And we find that pattern across most of the raters. So there is actually, there is something like a bias, like a perception bias.
Yeah, but I want to clarify that this is very human. Is that, if I'm friendly toward a company, then I tend to be more lenient, but it's not because of a manipulation or that is strategically behaving. It's just human biases. So it's important how you organize the evaluation of firms. If you order the firms by, if you order the rating agency by firms as opposed to attributes, then it's conceivable that one person that finds Tesla unacceptable, then they are very tough on Tesla everywhere. But another company, an analyst in charge of Tesla, is friendly to Tesla, and then tend to be friendly on all of the place. But I think it's more the human typical bias that psychologists have found, that when you rate something good, then you're likely to bring that assessment toward other dimensions of the person or the firm. Yes, but not the way the question was asked.
Mm-hmm. Very interesting. So one more question. So from Lars Sorensen, could some of the divergence be due to some vendors using a best-in-class, meaning relative to companies in the same industry approach, whereas others use an absolute approach? For example, the new Sustainalytics ESG risk rating. What do you think?
So yes, that does create different approaches. By the way, I actually think that best in practice or not best in practice should depend on the attribute that you are measuring. So, for example, again, let me take extreme positions. So, child labor. I don't think that we should measure best in practice on child labor. Like, well, we're all criminals, so I'm a little bit less criminal than the average. I mean, that's a horrible. So you see, child labor, irrespective of what you do, should be just absolute, period. And in fact, there should not even be an average. If everybody is a bad firm, then everybody should get, very negative numbers. There are some practices that could conceivably be about best practices. Things like, product safety, and aspects of that, that then you understand that, financial services are by construction safer than construction, for example. So in construction, you will have, some death that happens especially in high buildings. So the point here is that there are some areas in which you might want to have best in practice approaches and some that you will not want to have them. So in that sense, and because there's a disagreement between the rating agencies how they are actually doing this, it is conceivable that this is part of that measurement error that we're finding. That's correct.
Great. So there are many comments in the Q&A referencing your what you call the confetti slides, showing in different colors, different ratings by different agencies. And so specifically on that slide, Niral Parek is asking, well, first saying that he loved the slide, that it was quite telling. And the question is, did you see thematic differences on ratings across industry sectors? As in other sectors where there are more divergences than others?
We did an analysis. We didn't see it across sectors, but there's another question I saw about countries, and he pointed it out quite well. We saw actually differences between countries, and Japan was actually where there was a whole big divergence. And in a follow-up paper that we are writing with Anna, I think we are picking up on this measurement noise, and that it's bigger in Japan than in other countries. But yeah, well, I think that will still take a while, the paper, until it's out, hopefully maybe a month or two. And I invite you to check our SSN page, and yeah, in case you're interested, please download it.
Yeah, but we also found that there's very little convergence happening, no, Florian?
Yeah.
So through time, I understand these things evolve slowly, but when you look at from 2014 all the way to 2019, we don't have 2020 data, there's very little change. So the divergence tends to remain there for a while. So if there's any systematic, is systematic through time, but we didn't find very big differences across industries. And also, I want to say something important. One of the weaknesses of our paper is that we had to find a set of firms that were common to all 6 rating agencies. So that reduces the sample tremendously because they are not all rating all the companies. So if we continue getting even more granular to industry, then we will have like 4 firms. So it will be hard to make any statement. I'm exaggerating, but we only have 924 firms in our data. Is because by forcing us to get all of them to be rated, it reduces the sample significantly. So we have not found any particular pattern except this rater effect that Florian referred to.
Mm-hmm. Wonderful. So there's also lots of questions about the details that the raters use to compute this rating. Maybe Julian could answer that. So there is a question saying how much of these ratings are based on questionnaires to management and how much independently determined. That's the question for Eugene Bellin. And also Graham Sinclair is saying that this ESG research and ratings is very expensive. So how do you see the business model of these rating agencies? Could you please comment?
Oh, that's a great set of questions. So most raters use, as far as I know, a combination of publicly available records and questionnaires. And the reason is that publicly available records, you don't get coverage for sort of a really large sample of companies, right? Sort of because ESG disclosure is not mandatory, at least in many countries, it is not. So so you will only get data for a subset of companies, and to create a good product, you usually have to cover, the usual indices at least, and ideally like sort of a really large amount of companies. So there's 2 things that typically ESG rating agencies would do. One is to send the companies questionnaires, but also then you have no guarantee that they will be answered because they tend to get a lot of questionnaires these days. And another option is then to estimate, to impute data that you don't have. And there's actually an interesting paper by by a colleague, George Serafheim, where they show that the estimated data is more consistent compared to the measured data that comes through questionnaires and other means, indicating that the estimation models are very similar. I think that's an interesting result in that respect that we should highlight. And then the question about cost, I think, is absolutely essential, also with the future development of this space. If you imagine a sample of 4,000 companies on 100 indicators that you want to update twice a year, that is a lot of work, right? So cost savings will hopefully, one thing is just through scale, but then again, we probably still want several rating agencies. Some things around machine learning might help, where you sort of can scrape certain data points in vast numbers very cheaply. I think definitely what will help is more mandatory disclosure, because that will be easily available data to all kinds of competitors to base data ratings on. Yeah, so I think these are three ways that hopefully costs will come down, and they are, as you suggested in your question, and are related to the means of sourcing the data, obviously.
Mm-hmm. Great. So we are running out of time, so let me try to squeeze one or more questions in. Of course, everybody's interested in your opinion. If you were to predict which ESG rating would become an industry's leading standard, which one would you go for? The ones with the largest rateable universe, or the biggest number of indicators, or the most accurate? Do you have a prediction there?
I think at the moment coverage is a very important argument for most users, and quality is harder to assess. So I think I'm going to bet on coverage.
And I was going to say something about accuracy. It's a beautiful question, actually. The accuracy, this is an area where an accident happens, is going to be a devastating rare event. So this is not a credit event that happens, once a week, and you get, you like hundreds of people defaulting. So a credit rating agency has the ability to measure accuracy. Here, every time we have an accident or something bad happens, it tends to be tremendously rare and very harmful. So I don't think that accuracy will be part of that decision. So I think that Julian has coverage. I will add transparency to that. I think that the more transparent it becomes, the more transparent they tell you how they're constructing that index, the better it will be. But that collides with the previous question about the business model. The more transparent you are, it's going to be harder for these rating agencies to sell the data, no? But I think that's what I will pay attention. Florian.
Yeah, no, that actually sums it up quite well. But I mean, then on the other hand, it's very hard actually for us researchers even to tell what is the best rating, right? Because that is the most common question I get after that presentation from practitioners. And I mean, we don't have an answer to that, at least yet. And that's why we just compared them. That's what we did, right? So yeah, it's just almost impossible to say what is the best rating.
Wonderful. So I think on this fine note, let me thank Florian, Roberto, and Julian for a very insightful discussion. We have plenty of questions that we have not covered yet. So I know the Florian, Roberto, and Julian love to get feedback. So please do contact them for any feedback, and we will certainly post the videos when they become available. So I could see a lot of interest from the audience in this presentation. And so thank you very much.